Good morning. Why don't we get started here today? Thank you for joining us for this Affordable Care Act workshop on employer pay or play. I'm Dale Vlasic. I'm the chair of McDonald Hopkins Employee Benefits Practice Group. And with me today is Tony Pilsner. Tony is a member of the firm, also in the Employee Benefits Practice Group, and Tony is based in our Detroit office. We'll be happy to answer questions from the audience during this program. For those of you here in Cleveland, there are cards that you have. Feel free to write on them. We have staff that will pick them up and bring them so that we can try and answer them. For those of you that are on our webcast, feel free to, there's a thing that you can click, type your answer in, and it'll get transmitted to us as well. I do want to thank you for coming. Especially those people that are here in the Cleveland area. Those people on the webcast have no idea what I'm talking about, but they are filming a movie, Captain America, literally right outside this building. They have tied up major streets in downtown Cleveland, not only to cars, but also to pedestrians. So it was an adventure, and I do appreciate you coming and being here today. I do want to warn you that you may hear, and this is not a joke, you may hear gunfire and explosions. That is not a comment on the safety of the streets in Cleveland. And also to warn you, it is not the HR professionals in Northern Ohio rising up in rebellion against the Affordable Care Act, although I think some people are tempted to do that. So with that, caveat, seriously, you may hear all kinds of noise because they're getting ready to be filming literally right outside there are windows behind me. You can't see it. So if you see people in the audience rush to the windows, that's what's going on here. The genesis of this particular workshop comes from a program that Tony and I had put on with Meredith Fergus of our office a few months ago. And as part of that, people asked for something more in depth. Obviously, they're masochists and want to inflict pain on themselves, and so they wanted something more in depth to talk about rather than a high level. So the point of today is to try and dig down a little bit. We're going to spend 2 hours, both on the webcast and here in Cleveland in the live audience, going through some things more in detail. We're assuming you have a basic concepts of what's going on. We're going to talk about nose counting, who you have to offer coverage to. We're going to first start with going through and looking at determining out whether you're an applicable large employer. If you're an applicable large employer, you've got to offer health care coverage. Tony's going to spend a good deal of time talking about who you have to offer that coverage to and figuring that group out, because that one level sounds simple and one level it's not so simple. Then we're going to talk about how much can you charge and stay affordable, because that's one of the other key pieces to that. We'll talk about strategies to deal with this whole business of healthcare reform, things that you can do, things you can think about, or things you can talk to your clients about. And then finally, we'll end up talking about some pitfalls that are starting to emerge through this whole process. Now, I'm going to warn you, and Tony is going to warn you the same thing, is we will do our best to answer questions, okay? You've got to realize that Tony and I are kind of hamstrung. We can't use our standard legal answer, it depends, okay? There's a lot of the answers going to be, I don't know, okay? And we may be telling you stuff today. 6 months from now, we'll be telling you something totally different because we'll get more guidance. So as long as everybody understands those ground rules, we will do our best to answer, okay? For those people here in Cleveland, we will end the webcast at noon. For those people here in Cleveland, you can hang around. There will be, I believe it's a box lunch is going to be available, so there'll be a lunch available. Tony and I will be here, and we can have more informal discussion, question answers, however you want. Or if you want to go watch the movie, you can go do that. But that's kind of the format for today. So with that, let's jump in. Threshold question. Threshold question is, am I or is my client or is my company an applicable large employer? An applicable large employer is somebody who has at least 50 employees during business days during the preceding calendar year. So for those folks that you know you've got more than 50, you've got 125 people, you know you've got 125 people, you can kind of tune out right now, check your emails, whatever it is. You don't have to focus on that if you're over there. If you also know that you've clearly got less than 50, I'm glad you came. You can come for the free lunch, but a lot of the stuff we're going to talk about is not going to be applicable to you. So you got 25 people. You're not likely to grow to much larger than that for the foreseeable future. Some of these rules aren't going to impact you, okay? But for those people that are hovering right around the 50 or unsure, that's what we're going to spend some time talking about. The 50 employees for being an applicable large employer is calculated on a look-back period. So you're looking back to the preceding calendar year. The rules are going to go in effect into 2014. So what that means is we're looking at people today, here in 2013, to decide whether or not you're an applicable large employer for 2014. And then in 2014, you're going to be determining if you're an applicable large employer for 2015. It's just going to keep rolling forward. That's going to be a little different. Tony will get into it, not trying to steal Tony's thunder. She's going to get into it when we're talking about who you have to offer coverage to. It's not quite the same. Different rules. Of course. So, be too easy. Okay. So, who are we talking about? We are talking about all employers. Private employers, for-profit employers, not-for-profit employers. You all get tossed into this mix. Ironically, and maybe there's some justice here, it also includes the public sector. States have to deal with this too, and various government agencies have to deal with this. So they're figuring out, and most of them are going to be applicable large employers, but it also includes them as well. One of the things that can get a little tricky is that you have to determine and you have to look on a control group basis, okay? On a control group basis. For those of people that are used to dealing with your 401k plans and your retirement plans, you are using the same type rules. They just overlaid them. So if you've got a situation where you are dealing with a parent and a subsidiary, you're going to lump those two together. Even though they are totally separate for corporate purposes, they may be totally separate for how you run your businesses or how your clients run their businesses. You lump them back together. So you're dealing with parent subs, you're dealing with brothers, sisters, and you're also dealing with affiliated service group. So you roll all those back up. So kind of the simplest way, if you're used to dealing with the 401k world, all your companies that are rolled together for your 401k are rolled together for this as well. So you start with that. And it can be a little confusing dealing with one particular client, very large company, definitely more than 50, probably like 500, 600 employees, clearly over the limit. But the owners also had this little company that had about 25 or 30 people. And the little company was thinking it didn't have to worry about it. Well, they weren't happy when I told them, no, even though you only got 25 or 30 people, because you're part of the control group, you're an applicable large employer too. So that could impact you or your client companies in the sense that maybe they're part of a portfolio that a group of people own, that each one may have 25 or 30 people, but when you look at them across the whole group, they're going to have more. So you do need to look at it at a control group level. Now, a couple things, and for those people in the benefit areas, this will all make sense to you. Ironically, we don't have any leased employee rules here, which you do for your 401k. You don't have them for this. And you don't have any separate line of business exceptions here either. Now, most people go, if you don't know what a separate line of business is, don't worry about it. You don't need to know it. But those exceptions aren't there. So once we decide who the employer is, and you put all those pieces together, who do we have to count in 2013 for 2014? Well, what you do, you start by including all the common law employees. You include all the common law employees. Now you get into the issue that a lot of people have had about independent contractors and all of those, so that kind of question overlays into this as well. If these independent contractors really should be common law employees, they should be tossed into this, but so you include all the common law employees. You also include people that somebody else might be issuing a W-2 for, but are really your employees. Now, by that, I'm talking about, for the most part, I'm talking about professional employer organizations, PEOs. I know there are some PEOs that are on the webcast. I do a lot of work in the PEO arena. It's a little bit up in the air, but right now the way it seems to be working in that industry is you're going to count, the jargon is, at the client level. So if you are an employer, you are the client employer of a PEO, we're going to be looking at you. You're not going to take the PEO's people, all the other, could be a couple hundred, could be a couple thousand people, still looking at you, even though the PEO might be issuing the W-2s for your people. So they are still your people. You include seasonal employees, and we're going to talk about that because there's an exception of how you had to count them, but arguably, or at least you start with the fact that you include seasonal. So you're including your common law employees, you're including all your seasonal employees. You also include all your collective bargained employees. Even though you may have negotiated with the union to make contributions into a multi-employer health plan for them, you still toss them back into this mix. So all your real employees, all your PEO type employees that you may be using, all your union employees, you pull them back in. Now, you don't pull back in, or you don't count, employees who work entirely outside the U.S. So you've got sales reps in Canada or Belgium or wherever it is, you don't have to pull them back. Now that helps you. I mentioned the fact that we're talking about have to pull this thing on a control group basis. If you are a U.S. subsidiary of a foreign company, and maybe you only have 35 people here in the U.S. and maybe 1,000 people back in France, you don't have to count them, even though you're part of a control group, because all those folks are not employed in the U.S. So that's the group. Well, who do we have to count? Well, we have to count a full-time employee, and that is an employee who is employed an average of at least 30 hours per week during a calendar month. And the way this is supposed to work is you determine this separately for each calendar month. Now, if you don't want to really count hours, you can simply go and say, all right, any employee who's paid on an hourly basis, we don't really have them, maybe we've got a time clock or something like that, but so you don't want to do that. You can treat anyone who's paid on an hourly basis who works at least 130 hours during a calendar month as a full-time employee without going through and figuring out their weekly hours. So you can do that. You can use equivalencies. So anyone who works at least 30 hours. You're going to have people that aren't paid on an hourly basis, your office staff, your executives and so forth, they're going to be paid on some type of salary. You have separate rules for counting hours for those people who aren't paid on an hourly basis. And you have in the regulations equivalencies which you can use. And you can really actually count hours that these folks work. So you really go back in and figure out how much your salaried people really put in. Probably not really likely going to happen. Is very infrequent. Maybe for support staff, secretarial staff, or something like that you're worried about overtime issues, you might be tracking hours for them. But for your management folks, you're probably not going to be tracking. So you can do actual hours worked. You can do it on a day's worked equivalency, in which you treat 1 day worked, regardless of how much time they really spend there, as being 8 hours. You can do that. You can do it on a week's worked basis. So if you're tracking on a weekly basis, you give everyone who worked a week, 1 week will equal 40 hours. Now, you can use different methods for different groups of people as long as it's reasonable. So we can say, look, we're going to our secretarial support staff, we really do track hours, so we're going to track hours for them. Our executives or our sales folks who are on the road a lot, we're going to do it on a weekly basis. But you can't pick and choose simply by people. Oh, I like Sally, so I'm going to track her real hours. I don't like Steve, so I'm going to treat him differently. So you've got to be reasonable about it, but you can use different methodologies of calculating hours, equivalencies, for this. Now, one note for those folks is the Department of Labor has equivalencies out there already for the retirement plan world. They've had them since 1974 at least. Wow. Just to confuse you, these are different. Okay? Just to confuse you, these are different. So now, the other half of it is the DOL's equivalency hours for retirement plans are far more generous. So rather than 40 hours for a week, they count it as 45. So if you were to use those, you'd be more generous, but they are different, just so you know. And so don't try and take these and apply them to the 401k world, because they won't technically be appropriate and won't work. Okay. So you go through and you identify all your people who are full-time. And you know, very honestly, for a lot of them, you're going to know. This person's a full-time employee. They're regularly working, you know, 35 hours a week. I don't have to worry about them, so I'm going to put them in one bucket already. Where it starts to get confusing is dealing with people who don't really work full-time. They get tossed into this calculation. So I have to calculate full-time equivalent employees as well. And so you take all these other folks who are clearly, you know, they don't work your concept of 30 hours or 35 hours, whatever it is. Now you got to gather those. So your part-time people, your seasonal people, all of those, you pull into this bucket. And so what you do is you add up all the hours of people that are working for you that are not full-time already. You add up all their hours. You do it on a month. You don't count more than 120 hours for any one person. So if you've got a part-time person who is really cranking that particular month, you still only count 120, but you add up all of their hours. So you do that. Once you do that, you add that all up, and you divide it by 120, and that tells you how many full-time equivalents you have for that month. Just to give you an example, and you know, I asked for forbearance from the accountants in the room. I'm a lawyer, not an accountant, so that, you know, math is not my strong point. You know, you've got an employer that's got 15 employees that clearly work 35, 40 hours a week, so fine. So I got 15 that are going to be part of my group towards counting the 50. Then I've got another 60. Maybe this is a fast food franchise or something like that. So I got a lot of part-timers. So I got 60. Some of which are working 30 hours, some of which are working 20, and some of which are working 15, just making up numbers. And so if 10 of them are working 30, if I do that times, you know, 4 months, if you know, 4 weeks in a month or something like that, I come up with 1,200 hours. If I've got some that are working 20, I've got, say, 30 people working 20 hours. That's 2,040 hours, 2,400 hours, and 15 that are working 20. I add all this up, it comes up to 4,800. Divide by, I'm looking to her, because she's a CPA, looking at her, divide it by 120. That gives me 40 full-time equivalents. Give me a math check here. Okay, 40 full-time equivalents. So that's 40. I add my 40 to my 15. I've got 40. I've got 55. So now if I reduce the hours, move them around a little bit, maybe I don't. Okay? So that's kind of what you're doing. That's kind of the generic test. You're going to do that here in 2013. Now 2013 has a special rule because technically we've got this, you're doing this on an annual basis. For 2013, we're allowed to use a 6-month period that you can do this test for. So obviously you reduce things, but you can do it, so you got some time to figure out whether or not you're an applicable large employer for next year. Now you do have some exceptions for what are called seasonal employees. And the idea being here that there are folks, you're going to have influxes, you're going to have companies, you're going to have employers, you're going to have influxes of people. Kind of the classic examples are retail stores, where you're going to pick up a lot of people over the holiday season. And you may have lots and lots of people during that period of time and not so many during other parts. So there's seasonal employees. Landscaping businesses, things along those lines. Lots of people there over short periods of time, which can skew your results. There's a special rule for seasonal employees. Under the seasonal worker exception, if the daily total of full-time employees, full-time equivalent, exceeds 50 for 120 days or less in a single calendar year, even if the days aren't consecutive, so 120 days or less, you're over 50, and all of the employees during that 120-day period that are in excess of 50 are seasonal, then you don't have to be treated as an applicable full-time employer. So it's going to be particular industries. It's going to be retail. It's going to be landscaping. Construction, probably not so much, because you're probably going to have much more than that in construction. So you can do that. So you may be able, depending on your business or your client's business, be able to pull those people out. So you've got a nose count. You've got a nose count every year where you're near that, you're on that bubble. If you're clearly over, don't bother. Don't worry about it. For example, the firm, we have far more than 50. Tony and I haven't nose counted at all to figure out whether or not we're an applicable large employer. So I'm looking at the group here. I see a lot of folks that you know you're an applicable large employer. You're going to have to pay a lot of attention to what Tony's going to tell you next. So you're an applicable large employer. If you're under 50, a lot of this stuff isn't going to apply to you at all. You're welcome to stay for the lunch, but you don't have to, technically right now you don't have to comply with this. If you're right on that bubble and you're just underneath it, there are other rules that you're going to have to deal with, like the non-discrimination rules we'll touch on just briefly at the end. Your insurance programs are going to change a lot, potentially because you're not going to be able to buy policies that don't look like what the applicable large employers have to do with. But so you need to stay current with those kinds of issues, but you don't need to worry about complying with this. Now with that, for those folks that were checking your emails, now you need to come back, pay attention, because the next step, if you're an applicable large employer, in 2014, in order to avoid the penalties, if you decide to play rather than pay, you're going to have to be doing some things. You're going to be you will need to offer essentially essential benefits with minimum value and affordability to who, Tony? Who do they have to offer it to?
Well, full-time employees, but of course it's not exactly the same definition, because that would be, and you don't count it exactly the same way. That'd be way too easy. And I need to have visuals for this, because this gets a little more complicated. But if you've heard about look-back periods and stability periods and administrative periods and what those all are, that's what I'm going to talk about. But I want to preface that by saying, echoing what Dale had said, there's some people who aren't really, you're not going to have to count this way. People who are clearly full-time employees, you don't have to go through this. In fact, this is a voluntary program. You don't have to go through this at all, this look-back method. But understand that the penalty applies on a monthly basis. And it applies to anyone, potentially applies to anyone to whom you're not offering affordable minimum value coverage in any calendar month. Understanding and realizing that it'd be really tough to tell from month to month who is or who isn't, especially when you have a workforce whose hours vary. The agencies have given us this look-back methodology to use so that we have a period that we know for a definite period of time someone's a full-time employee or they're not a full-time employee. And we don't have to worry about that every month. Do we have to offer them coverage? Do we not? We have a set period of time where we know how they're being classified and how they're not. That said, for folks who are clearly working 30 or more hours a week, you don't have to track their hours. You don't have to go through this, because they're full-time. You're going to have to offer them coverage. Folks who are always for the most part, consistently working under that threshold, you probably don't have to count them either. This is averaged over an extended period of time, anywhere from 6 to 12 months of your choosing. If you're doing it over a calendar year, or over 12 months, which is what most employers want to do because they want the longest stability period, to the extent somebody regularly works 25 hours and maybe they go up to 35 a couple times a year to cover for people on vacation, they're not going to average out to 30 hours a week over the course of the year. So you don't have to count them either. This is going to be for if you're concerned with only offering coverage that you have to avoid the penalty, and you only want to offer to the people you have to offer it to, the folks whose hours vary, you're going to need to do this. It's also valuable to the extent that you're not offering affordable minimum value coverage to everybody, and if somebody goes out, gets coverage, and gets a tax credit, and you have a penalty imposed, if you want to be able to say, no, they weren't a full-time employee, I wasn't required to offer them coverage, you would need this kind of data to back that up. So it's not going to necessarily be all of your employees. Like I said, anybody who's clearly full-time or clearly under that 30-hour threshold over the course of the year, you don't have to count. It's just going to be the folks whose hours vary, who's, and to the extent that you don't want to offer them coverage if you don't have to, those are the people you're going to have to go through this tracking process for. So another comment is you have to count all of your common law employees. All the folks that Dale said you had to include, you're including them here as well. There's no exception for union employees. There's no exception for folks who have other coverage. Doesn't matter if if they have Medicare, doesn't matter if they're covered under a spouse's policy or a parent's policy, doesn't matter. You have to count them all. There's no, which is probably good because you don't have to worry about everybody's individual statuses. But if you're going to count, all of your employees get counted for this. You don't get to exclude them based on other coverage, based on whether or not they're paid through a PEO or not. We're going back to who are all your true employees. There are equivalencies for this as well. Fortunately, they're the same ones that Dale was talking about. So it's if you want to use equivalencies, it's 8 hours for any single day where there's an hour worked, or 40 hours for any week in which there's a single hour worked. The other thing to keep in mind, if you have an employee, if you're in a controlled group and that person's working for more than one member of the control group, you have to consolidate those hours. So you can't avoid it by setting up a bunch of little entities and saying, well, they're going to be on this payroll for 2 months and this payroll for 2 months and this payroll. It's not going to work. All hours worked for everybody in the control group have to be accumulated for this purpose. So with that, when we're talking about stability periods and measurement periods and administrative periods, we kind of have to start backwards when we're setting these. For the most part, as an employer, you're going to want, it's going to make sense to have your stability period, which is the period in which somebody's status is predetermined, usually correspond to your plan year. That way you don't have people moving in and out of your plan during the year, and that's a 12-month period. You have to pick that first.
Uh-oh.
There we go. So in this example, we're picking a calendar year. And we're starting with 2015. So if we want our stability period to be the calendar year, we have to start there, because we have to back into what our other periods are going to be. So presuming we want the calendar year, we start from there. Now you're allowed to have an administrative period, during which time you calculate whether or not somebody's a full-time employee, offer them enrollment if you have to, so that their coverage can be effective on the first day of your stability period. The longest administrative period you can have is 90 days. Not 3 calendar months, 90 days. So if you're in a calendar year situation, it would have to be October 3rd. It can't be October 1st because October 1st to December 31st is 92 days. So keep that in mind. For our illustration, we're going to say we want it to be 2 months. We want it to be November and December. So now we're backing up. So we have our administrative period before the beginning of our stability period. Well, then before our administrative period comes our measurement period. And the rule for that is your stability period cannot be longer than your measurement period. So if you want a 12-month stability period, you have to have a 12-month measurement period. So when we tack that on, we now are backing up our measurement period to beginning November 1st of 2013. It's running till October 31st of 2014. We have our 2 months of administration to do our averaging, figure out who's full-time, get them in the open enrollment process if we have to, so that their coverage, if they're full-time, can be effective January 1 of 2015. So we kind of have to back into it, because the stability period is really the period you want to control. You really want, it's preferable to line it up with your plan year so that you don't have different open enrollment periods for anybody. You can run everything on the same schedule. And if you're on a fiscal year, you would adjust this accordingly. Now, given the fact that we got these rules at the beginning of January, I believe, of this year, the agencies realized that if you were going to do a 12-month stability period for 2014 and any administrative period of whatever, you would have had to have started counting hours before this guidance even came out, because you would have to have backed it up to November or October of 2012. So for 2013, going into 2014, there is a transition rule. You can have a stability period of 12 months as long as you have a measurement period of at least 6 months. And it doesn't start after July 1 of 2013. So, backing into that, presuming we want a stability period of the calendar year of 2014, an administrative period of 2 months, we now have to measure in 2013 from May 1st to October 31st. And that can determine who our full-time employees are for all of 2014. But you're going to have to use a full year, a full 12-month measurement period for your 2015 determination. It's just for the transition year for 2013. So you have a little bit of a break. Understanding that for some people, depending on if you have seasonal employees and they're employed during that period of time, you may want to push that back a little bit, maybe make it April. You're still stuck with the maximum 90-day administrative period, but there is some flexibility. If you have a lot of people working in June, July, August, and you'd like to kind of give them a longer period to average their hours out, so to speak, you have a little bit of flexibility in doing that. You're not stuck with the same 12 months. But it's limited. For the most part, people are just going to be using their 6 months. It's still averaged over the 6 months. But when you're averaging over a year, you've got more, basically, perhaps less working time for folks who are seasonal, folks who are starting in the middle of the year, ending in the middle of the year. You've got more time to average it out. But you're not going to get that much time in the 2013 transition period, because you're limited to how long you can have that transition period in 2013. So that's how it'll work from year to year for anybody who's employed on the first day of your standard measurement period. You're going to count them for your measurement period. Use the administrative period to figure out, did they average at least 30 hours over that entire measurement period? And if they did, you treat them as a full-time employee for all of the stability period. So they're offered coverage for the entire next 12 months. Similarly, if they weren't a full-time employee during that standard measurement period, you don't have to offer them coverage at all in the stability period, unless they change positions and they go into something that's a full-time position, a regular full-time position, because you would treat them as a new hire. So that's the benefit. You're going through all this measurement and tracking of hours so that you have a period of time where you already know what somebody's status is. They're not going to be changing from month to month in the current year. You're going to know on December 31st of 2013 who your full-time employees are for 2014. So there's a benefit to that from an administrative standpoint. I should mention here as well that this methodology only works for variable hour employees and seasonal employees. Someone you hire in brand new as a full-time employee, at the time you hire them in, you know they're going to be working 30 hours or more a week, either because that's the position they're replacing or people in comparable positions are full-time. You have to offer them coverage within the first 3 calendar months. They don't get this look-back period. They're full-time from the day they walk in the door. So this doesn't work for them. It only works for variable hour employees or seasonal employees. Again, full-time, you have to offer them coverage. You don't get a year to figure out if I have to offer them coverage. That was carved out. So that's your year-to-year process. Of course, if you hire a variable hour employee or a seasonal employee during the year, this doesn't work so well. So you have a different process that starts getting a little more complicated. When somebody is hired in after the first day of your standard measurement period, and they're a variable hour employee or a seasonal employee, they get their own personal initial standard measurement period. And it starts, wait a minute, where'd that go? Okay. Did I already go? I already went through this. All right, this is, I'm sorry, I thought the slides were in a different order. That's my fault. This is just illustrating what I was talking about. From year to year, standard measurement period, they will overlap the administrative period. But it's something that will go with the same pattern from year to year. In your stability period, you will know who your full-time employees are during that stability period. You will start counting for the next measurement period at the beginning of the administrative period for the last measurement period. So you're always tracking hours, you're always counting, you're always calculating. But again, it's variable hour employees, seasonal employees. Full-timers are going to have to be offered coverage regardless. So in this case, our next standard measurement period starts November of 2014, runs to October of 2015. We now have an administrative period at the end of 15, which will then tell us who our full-time employees are in 2016. So it's going to be like the full-time equivalents. You're going to be doing this over and over every year for anybody who isn't clearly a full-time employee or isn't clearly not a full-time employee. Here we go. So we have a new employee, and they hire in after the first day of the standard measurement period. They get their own personal initial measurement period, and it starts on the day they're hired. And it runs for whatever measurement period you've decided to use for your full-time employees. Again, it doesn't have to be 12 months, but if you want their stability period to be 12 months, your measurement period is going to have to be 12 months as well. So we're going to take the maximum period because we want that determination to last for the longest period of time. We don't want to keep doing this over and over. So someone here hires February 10th of 2014. Their individual initial measurement period runs from their hire date to February 9th of 2015. So you're tracking their hours and averaging them out for that initial period. You then can have an administrative period. It cannot run till longer than the end of the calendar month following the calendar month in which your measurement period ends. So a maximum of 13 months for your initial measurement period and your initial administrative period. And in this case, we're running it till the end of March. We're going to run it till the end of the next calendar month because we want to be able to average those hours out, get time to offer them coverage if we have to, so that if they're full-time, based on that initial measurement period, we can offer them coverage as of the first day of their initial stability period, which is going to be April 1st. If they're a full-time employee during that initial measurement period, we have to treat them as a full-time employee for a full 12 months. So they're going to be a full-time employee until March 31st of 2016, starting April 1st and running till March 31st of 2016. If they were not a full-time employee during their initial measurement period, because we can't make this simple, we can only not treat them as a full-time employee until the end of the standard stability period that ends during that initial stability period. So in this case, it would run till the end of 2015. Because while we're counting that initial measurement period, and we're doing that special little year for them, we also have to start counting their hours at the beginning of the next standard measurement period, because we have to put them in the same rotation as everybody else. So we're actually running concurrent. So we start counting their hours again, November 1st of 2014, for that standard measurement period. And then we count the hours separately for that 12-month period, average it out. We have our standard administrative period associated with that. If they're a full-time employee during their first standard measurement period, then they're treated as a full-time employee for the first standard stability period, which, as you can see, overlaps a little bit with their initial standard stability period. So now we've put them on the same rotation as all of our other employees. If, this is where it starts getting a little more tricky. If for some reason,
As if it wasn't already.
if for some reason they're full-time during their initial measurement period, but not during the standard measurement period, we still have to offer them coverage till March 15th of 2016 because they were full-time during their initial measurement period. But as of April 1st of 2016, we could cease to offer them coverage because they weren't a full-time employee during their standard measurement period. So, from an administrative standpoint, you'd want to think, would you really want to drop them in the middle of the year, or would you just want to let them run the year out? You're offering them coverage. You've already given them coverage, in this case, for 3 months of the plan year. Do you really want to go through the process of taking them off your coverage in the middle of the year, even if you can do it? This is a business decision, an administrative decision. Do you really want that many people falling in and out of your plan during the year? And it may be you just don't want to offer coverage if you don't have to, and if you're only offering coverage to avoid the penalty. You may want to say, fine, April 1, sorry, you're off the coverage. You will know this for them by January 1. You will give them time to tell them that they're going to be off the coverage. Keep in mind, they're losing coverage because of a reduction in work schedule. You will have to offer them COBRA. Another reason why you may just want to leave them on the coverage. But this is technically what you can do if you only want to offer coverage to avoid the penalty. This is how these work, which is why I also said you probably want to do this for as few employees as you can. You really don't want to have to track anybody if they're clearly going to be a full-time employee or they're clearly not a full-time employee, because this can probably be fairly administratively burdensome. A comment that has been pointed out to the agencies, but the trade-off is for a year at a time. The other alternative is that every month you have to decide, is somebody a full-time employee? And you can't really do that on a retroactive basis. So how can you tell if somebody's going to be a full-time employee this month so you can offer them coverage this month? You're not allowed to say, well, you were full-time last month, so I will give you coverage this month. You can't do it on a month-by-month basis. This is the only way you can do it with a look back. So again, it's kind of do you want to just offer coverage to everybody? We're going to talk about a couple of strategies to deal with some of that so you can avoid some of this. But if you really just you don't want to be exposed to the penalties, but you only want to offer coverage when you have to, this is pretty much your only option for that. So, and we put it, as you can probably see now why we had to put it into a visual format to show you how this overlaps, because just telling you about it doesn't quite convey how much fun it can possibly be. A couple other points. I want to talk about what's a variable hour employee, because I've been referring to that, and this is how people you have to count. A variable hour employee is somebody that at the time you hire them, you cannot reasonably determine, as of their hire date, that they're going to be consistently working at least 30 hours a week. This means their schedule is going to vary. It does not mean they're going to work full-time for a short period of time. It only goes to the number of hours they're working, not the duration of their employment. So if you're hiring somebody and you know it's going to be for 6 months and they're going to be full-time, you still have to count them. And you would have to offer them coverage as a full-time employee. A variable hour employee only goes to a schedule that's going to fluctuate over and under 30 hours a week. The proposed regulations are very clear at this point that it doesn't go to limited duration assignments or limited duration employment. So even if you're hiring somebody for only a couple of months, if they're going to be full-time as of the time you hire them, they have to be treated as a full-time employee. And this is also for seasonal employees. And Dale mentioned seasonal employees. And the definition of seasonal truly goes to the type of work and whether the work is seasonal, not the availability of the workers. So for those of you who have hired students during the summer, They're not seasonal because unless the work they're doing can't be done any other time of the year. So if they're just, we have summer associates. They're not seasonal because the work they do can be done any time of the year. But landscaping, farm work, amusement parks that are only open during the summer months, again, retail employees during the holidays, the work is keyed to the season, not the availability of the workers. So students that come in between terms or interns, they may be of limited duration, but they're not going to be seasonal. So you can't use the look-back process for them if they're coming in and working a full-time schedule. There's also the question of what do you do with somebody who, usually in the context of seasonal, you've hired them last year, they come back this year. Do we start counting them all over? Do we start counting their hours over again? Do we treat them as a new employee? Sort of, depends. There's a threshold. If they're returning to your employment less than 26 weeks, 26 consecutive weeks after they last worked for you, they basically pick up where they left off, meaning whatever status they had when they left is full-time or not full-time, they pick up when they come back. You do not treat them as a new employee. So to the extent you've got seasonal workers that are working, through September, October, they come back in March, they haven't had a break of 26 consecutive weeks in some cases. They would come back, and if they were full-time employees as of the time they left, because of the number of hours they worked averaged over the year, they'd be full-time when they came back. There is a separate rule for absences of less than 26 weeks. If somebody's gone for 26 weeks, less than 26 weeks, you can use what's called a rule of parity, which means if their length of their absence, the time they're not employed, is greater than the length of time they were employed, the last time they were employed with you, you can treat them as a new employee. So for example, somebody comes in and they work 20 weeks. They leave, and they come back in 24 weeks. You get to treat them as a new employee under the rule of parity because they were gone longer than they worked. That requires tracking how long they've been gone, how long they were working. Again, an administrative issue, but it's one way to address that. If you make sure that your seasonal folks are gone for 26 consecutive weeks, you can always treat them as new employees. That's the other way of looking at this. It's the 26-week threshold. If they're gone for 26 weeks, they're a new employee when they walk back in the door. If it's less than 26 weeks, and you either have to apply the rule of parity, or they come back as they were. So it'd be the same thing for somebody who leaves and then you rehire. They go on an unpaid leave of absence, for example, for 6 months. They would basically, if it's more than 26 weeks or more, they come back as a new employee. If it's less than 26 weeks, they step back into the status they were when they left. So you can't hire and fire people and start counting their time over. That's to avoid that kind of potential for abuse, so to speak, in this. Now, and another thing to keep in mind, there are certain types of leaves that don't get counted as 0 hours. For the most part, if somebody's not working, they're on an unpaid leave, 0 hours goes into their equation. Paid leave would be treated as hours worked. But for the most part, you're not giving paid leave to your part-timers or your variable hour people, so it's usually not going to be an issue. But unpaid leave gets counted as zeros for those weeks, except, because we can't have anything be simple, FMLA leave, those weeks get dropped out of the equation. Military leave gets dropped out of the equation. And jury duty, because apparently we want to encourage people to partake in the civic process, and jury duty weeks are also dropped out of the equation. So you can't average those in at zeros. They're just not counted as weeks at all. So that's the short version of how that all works. And again, it's intended to give you some sense of stability. You have to make a business decision as to whether or not it makes sense to go through all of that administrative hassle, or if you want to just face the penalty or adopt a strategy or a structure, which we're going to talk about, that can possibly insulate you from perhaps not, in some cases all of the penalties, but it's certainly the larger of the two penalties.
And I think one of the things to echo what Tony had mentioned in terms of this is all of that overlay and all of that counting, we're dealing with folks who aren't normally full-time employees. That's the only time you're dealing with this. If your workforce is, we always hire people for 35 hours a week, all our positions are full-time, you're not doing any of that stuff. This is only for groups of people that you don't know if they're going to be working 30 hours a week or not. So if typically you're hiring people for 35 hours a week, you don't do any of that.
Right.
So this is where you've got a workforce, you're going to be doing this kind of stuff for yourself, for your clients, where you're doing this kind of workforce where you've got a lot of variable hour people. You know, you're running an amusement park, you're running a, potentially a fast food restaurant where you've got lots of people that work weird shifts and things like that. That's where you're going to be doing this. Kind of in a normal business, you're probably not going to be doing any of those kinds of things. Tony, looks like we have a question.
Oh yeah, there's a question. Our full-time employees are eligible for benefits after 1 month of employment. Will we be required to offer an intern benefits if they work 40 hours a week for 3 months? The key here is the 3 months. By the law, you have up to 90 days before you have to offer them benefits. So if you want to create a separate category for your interns and say you would get benefits after 90 days and they stay less than 90 days, you don't have to offer them benefits. If they're going to be there longer than 90 days, you would have to offer it. Keeping in mind, in a lot of cases, your interns are going to be covered on their parents, and they're probably not going to take your coverage. They're probably not going to go to the exchange and get a penalty and get coverage and expose you to a penalty. But if you want to be sure, you would offer them coverage. We don't have, under the existing non-discrimination rules for self-insured plans, we believe it's permissible to have a different waiting period for different identifiable categories of employees. So you could have 1 month for your regular full-time, 90 days for your interns. We don't have the non-discrimination rules for insured plans yet. They're still sitting out there hovering, and we presume they're going to be fairly similar, that you're going to be able to have different eligibility requirements, because the new rule is you're going to have to offer benefits with no longer than a 90-day waiting period. We're guessing they're going to coordinate, but we don't know yet, because there's certainly some question about the whole 90-day waiting period and why it doesn't run to the first day of the next month. There's a lot of pushback. If that's been your concern, those comments have been voiced to the agencies, that's how a lot of employers are set up right now. Why can't we leave it there? We want to do it at the beginning of a calendar month. We either have to back it up, and we don't have an answer on that yet. The current regs are proposed. They're technically not law yet. If you want to take a flyer and say, we're going to do it 90 days, we're going to do it the first of the month after, because the proposed regulations aren't law yet. My only caveat to you there would be that the statute, the law says 90-day waiting period. If you're going beyond 90 days, you're clearly in violation of the statute at this point in time, and without a regulatory excuse, you would arguably be in violation of the statute. But as far as your interns, at this point, based on what we know, we believe it would be possible to have a different waiting period for them that would be longer than your regular full-time people, so that you could make them wait the maximum period of time and hope that they would be gone before you would have to offer them coverage.
Right. Well, we've got a couple of additional questions, some of which we'll talk about, so I'm going to take this a little bit out of order. And it kind of goes to the same question you're answering. The question is, how long can you have as a probationary period before offering coverage, or do you have to offer coverage day one?
90 days. It's the maximum period of time you're allowed to make somebody wait for coverage when they're as a full-time employee. Because part-time employees, well, I take that back. 90 days for anybody you're offering coverage to. If you're going to offer them coverage, even if they're part-timers, you cannot make them wait more than 90 days. Because you don't have to offer coverage to part-timers, and the law recognizes that, but it also recognizes that if you're going to offer them coverage, you can't make them wait more than 90 days. So probationary period, you know, if you had a 6-month probationary period, you're not going to be able to have that anymore. It's going to be 90 days.
We had a question dealing with becoming an applicable large employer. I mentioned that we've got the control group issues, and so the question was raised from the audience. Well, I'm under 50 right now, clearly under 50, and then there's an acquisition. Either I buy another company or I get bought by another company. You know, how long do I have to deal with this? Well, the rules, and Tony, jump in if you think differently. The rules are, it's a look back period.
Right.
Because you're looking back to the prior year. So let's say the acquisition happens right now, today. You count your noses for 2013, you figure you've got less than 50, so you are not an applicable large employer for 2014. In 2014, you get bought by Apple Computers. So now clearly you are part of a large employer. Okay? Well, you're still not a large employer for 2014.
No.
You will be for 2015. So it's a little, once again, just to confuse things, 401k rules are totally different rules there, but you would not be. So you've got, depending upon when the transaction happens, it happens on December 31st, like a lot of transactions, we got to worry about it.
Right. And the good parallel to that is COBRA. COBRA, whether or not you're subject to COBRA is always determined on a look-back period. 20 employees in the prior calendar year determines whether you're subject to COBRA for the current calendar year. Same thing here. It's, as of January 1, you know if you're an applicable large employer. And you will know that till the following January 1.
A couple questions about your presentation.
Okay.
Not that you did anything wrong, but the question is what...
It's so clear. I don't
exactly,
understand.
yeah. Not quite as clear as the 90 days that you came up with, okay? But questions, what exactly is measured in the measurement period?
What is measured in the measurement period is actual hours worked. It's not hours scheduled, it's hours worked. And again, if you don't want to count actual hours worked, you can use equivalencies. The equivalencies probably aren't going to get you where you want to go because they are very generous. The equivalency is you work 1 hour in a week, you get 40 hours of credit if you're going to do the weekly equivalency. Or if you work 1 hour in a day, you get 8 hours. So equivalencies are not probably going to help you here, but you can use them if you want to. But what you're counting are actual hours worked. You're also counting, as I said, paid leave, but in this situation, it's probably unlikely people who you're counting, seasonal and variable hour employees, may very well not get paid leave. But if they do, paid leave is counted. Unpaid leave is not unless it's FMLA, military, or jury duty.
Well, some of the people obviously don't want to do this by hand, and the question is, are there software products or payroll companies with services that'll do these calculations for you?
Wow, I'd like to hope so.
I'm assuming, this is America. We look for advantages. There will be people that will sell you products that will do this, is what I'm feeling. I'm not aware of any right now. I know, the companies, I'm sure, not throwing names out, ADP or any of the other companies will certainly come up with some type of product where they're already tracking your hours already. They'll create it. I know the PEO industry is working diligently to help folks because they are tracking stuff. So the answer is there probably will be, but I don't, as I sit here today, know of any.
I haven't actually seen one yet, but I know there's a lot of employers who are looking for it, trying to integrate it with their existing payroll systems because that's going to be the best way to do it. You don't want to recreate the data. You want to pull it out of that system. But I have not seen or reviewed or heard of anything in particular. But you're right. This is an entrepreneurial opportunity here.
Yep. I mean, for some of you folks who are veterans, remember Section 89, which was a lot of very similar rules were put in place. I know a lot of companies jumped in this and started developing things. Then they repealed it. So this is not going to get repealed. So if
not soon.
Not soon. So we're going to have to deal with this. So this isn't going to be a Section 89 experience for those. I see a lot of young folks have no idea what I'm talking about, but the veterans out there know what I'm talking about. One last question before we move on.
Okay.
Are there special considerations, guidance for firms that employ contract employees, that hours may vary or assignments may stop or start during a 90-day period? I think it gets to the point where, to your point, if you've hired somebody to be full-time.
If we're talking about somebody, and if I'm understanding contract employee, it's somebody who's being hired for a specific project, but they are still your employee. And again, it's going to come down to what is their hours expectation at the time of hire. If you're hiring them understanding that they're going to be working at least 30 hours a week, even if you know it's for a short duration, the duration doesn't matter. It's what their hours are going to be when they're hired in. So if they're going to be 30 hours or more, and that's the understanding, that's the expectation, other people you're hiring for this project are in the same position. When you've hired for projects in the past you've done, they've been full-time, they're going to be full-time employees on day one, and you're going to have to offer them coverage within the 90-day period. If, however, you honestly don't know how many hours they're going to be working. I mean, it could be all over the map. I mean, we don't look at duration. We're going to look at the average number of hours during the week as of the date of hire. If we can't reasonably say we know it's going to be over that 30-hour a week threshold, they're a variable hour employee. So, you know, again, to the extent that you push out your waiting period to 90 days, if somebody's not going to stay 90 days, you wouldn't have to offer them the coverage because they're not going to be here by the end of that waiting period. But the determination is always the hours expectation when you hire them, not the duration of the assignment.
Question about counting hours. Why do hourly employees use 130 hours a month for calculations and part-timers use 120 hours per month?
I have no idea why that's different.
Yeah.
You know, the only thing I can think of is that a full-timer is usually going to work more than 4 straight weeks in a month. They're going to have, you know, there's always going to be, you know, there's not 28 days in every month. That's the only thing I can think of, but I don't know that it's been articulated as to why that is a different standard.
So we'll have to figure that one out. We don't have an answer for you on that one.
We may not know.
Yeah, we may not know. Okay. We got some other questions here. I'm not going to ignore them, but I think we're going to work them in as we do other parts of the program. I think they'll fit in, I don't know, better, but at least they'll have a certain logic to what's going on. All right. You're an applicable full-time, applicable large employer. You've identified who your full-time employees are or potentially are. What do you got to do? Assuming that, once again, that you want to play rather than pay. Well, the idea is you have to offer coverage that is going to meet certain minimum standards and levels of coverage and things like that. We're not going to get into that. I mean, if people got questions, we'll answer them. But for the most part, I think it's my belief, and I assume Tony's belief as well, is the insurance markets out there aren't going to have products that don't comply with those rules. They will be out there. They will be the product for you to buy. If you're self-insured and somehow you're not grandfathered, you're going to have a product one way or the other that's going to comply with all of the requirements, offer the essential benefits at the levels you have to. So putting that aside, you're going to have a product out there. You have to offer it to folks, and we'll talk a little bit about that in a few minutes. But you have to offer it, and it has to be affordable. Okay? It has to be affordable. Well, what does affordable mean? Well, in the statute, affordability is measured such that the employee's contribution for single-person coverage, we'll talk a little bit about that, for single-person coverage cannot exceed 9.5% of the employee's household income. 9.5% of the employee's household income. Household income means the employee's modified adjusted gross income and the members of the employee's families who are required to file tax return. That means their spouse and their dependents' modified adjusted gross income. Now, for the accountants out there, or you've done your own taxes, have you TurboTax, whatever, you know, we all know modified adjusted gross income. I don't know my modified adjusted gross income, let alone any of my employees' modified adjusted gross income. You haven't the faintest idea.
And you probably don't want to know.
Yeah.
I mean, you don't want to have to go into that. So we've been given some safe harbors for determining affordability. And if you satisfy one of the safe harbors, you will be deemed to be offering affordable coverage. And as Dale mentioned, this is single-only coverage. It's the employee's required contribution for single coverage. You're not required to subsidize dependent coverage. that falls out of the equation. But you are required to offer coverage for children, your employees' children, not their spouses. So part of the offering question is offering coverage to dependents, but you're not required to subsidize the dependent coverage. Affordability. There are 3 safe harbors. The first one is the Form W-2 safe harbor. And to satisfy that safe harbor, an employee's required contribution for single coverage can't exceed 9.5% of the taxable wages on the W-2 they receive from you. Problems with this safe harbor, and there are several. First one is box 1 is after 401k contributions, it's after cafeteria plan contributions, it's not full gross wages. So if you've got somebody who's, and the common scenario is you have a working couple and one of them maxes out the 401k every year and puts as much as they can into that, so their taxable wages are lower by 17, 18, 22, 23,000 if they're over 50. Well, that can make a big difference in what their affordability standard is. The other problem, or if they're putting money into a flexible spending account, into a dependent care spending account, if they're paying for their health premiums on a pre-tax basis, that's all coming out of the box 1 taxable wages as well. So that's all reducing that, and it starts becoming a circular calculation because they have to pay that, and that's reducing the 9.5%. But the other bigger problem is you can only be sure of this after the fact. You can only be sure of it after the W-2's been prepared and calculated. Now, arguably you could program, or you could calculate what somebody's W-2 wages are every month and adjust their premium, but that's kind of impractical, and you could still miss it at the back end. The only way you can be sure of is on a retrospective basis, and then it's too late. You can't fix it after the end of the year. So while it is a safe harbor, and not too many people are
yeah, I mean, I
hooking up with that.
When I first saw that, I thought, this is great, W-2. Employers know W-2. They don't know, household income. They know W-2. But I came to the same realization as Tony's mentioning, is that it's not really going to be all that workable because you won't know till after the fact. The other piece, it penalizes you for, I know a lot of folks out here have got 401k plans. They've got automatic enrollment in 401k plans where you're automatically putting somebody in because you're encouraging them to save for retirement, and so you're putting them in at 3%. Well, you're shooting yourself in the foot on affordability by doing that if you're using this particular safe harbor. I'm not telling you don't use it, but it isn't as simple and as such a nice magic bullet as you might initially think it to be. So we've got 2 other options.
We have 2 other ones, and the second one is actually more workable because, again, it gives you some sense, like the stability period issue, it's something that you can establish up front for the whole year, and then you know what your affordability standard is, and it's called the rate of pay safe harbor. And to calculate this, it's as of the first day of the plan year. You take each employee's, either their salary if they're a salaried employee, or if they're an hourly employee, you take their gross hourly wage times 130 hours. And you multiply that by 9.5%. And that's what the maximum contribution you can require of them for the rest of the plan year. You can't adjust it during the year if their hourly wage or their salary goes up. You can't adjust it for an hourly person if they normally work more than 130 hours. That's what you're stuck with. But you know what that threshold is now. You know what affordability is going to be for the entire plan year. For example, if in Ohio minimum wage is $7.85, isn't it?
I think so.
Okay.
I think so.
So at 130 hours, 9.5%, that's $96.95. So somebody who's working minimum wage, you can require them to pay $96.95 a month for single-only coverage, and that's affordable coverage. If it goes up to, if you're paying somebody $10 an hour, you're up to $123.50. But again, there's some regularity and stability. It's set up front at the beginning of the year. It's not going to change during the year, and you know what it is. And you can plan your required contributions around that. So that's a better, perhaps, safe harbor for a lot of people. The other thing, and keep in mind, you probably don't want to individualize everybody's contribution. You don't want everybody's contribution to be different. It'll make your payroll people crazy. You can bracket people. Take certain groups of people, group them by compensation levels, group them by job classifications, and establish different rates of contribution for different bands of employees. As a general rule, under the existing non-discrimination rules for self-insured plans, it's never a problem to charge higher paid people more for their coverage. Not a problem. We presume it will be the same under the fully insured non-discrimination rules. So you're not going to have a non-discrimination issue with increasing the required contribution for folks who have higher compensation. But that would get you around charging each person an individual level of contribution. You could band it and just set it at 9.5% of the lowest wages or salary in that band. And you would be affordable for that entire year. So that's slightly more workable, and it gives you more variation based on what your employees are making. You're not using one single number for everybody, which is sort of where the third safe harbor is.
Yeah. So if this is causing you to tear your hair out, and you have no idea what to offer folks, and things are moving around and bouncing around, the last safe harbor right now, based on the regulations, is you can use the federal poverty line safe harbor, which says that you can measure how much they have to contribute based on the employee's contribution for the lowest paid self-only coverage does not exceed 9.5% of the monthly amount equal to 1/12 of the federal poverty line limit, if you will, for a single individual for the applicable calendar year. It's fixed at the beginning of the year. You know what it is. The government's pulled that number out. You can calculate it. The problem is it's low. For 2013, based on my looking at it, which you'd be using this in 2014, the 2013 federal poverty line is $11,170 for the year. So 1/12, once again, check my math, accountants out there, is a little over $900. So 9.5% of that is like $88 a month. I don't know anybody who charges just $88 a month. It'd be great coverage, but you could do that. It's fixed, it's calculable, it isn't going to bounce around, you can do it. So that is out there as the third option. So it's one of these things we're going to be working through. We did have a question, so what do we do, and this fits into some of the things you were talking about, Tony. What about variable wage workers, construction workers who work during the summer, a lot of overtime, definitely well under the 9.5% in August, but come December when they're not working, not so affordable anymore.
Well, if they're not working, they're not your employee, you don't have an obligation to offer them coverage. So that's one thing. I mean, to the extent that you say that you've severed their employment relationship, they're not working for you anymore, you don't have an obligation to offer them coverage. But for folks who even have variable hours to the point that they're going to be a full-time employee, and again, variable hour people, we're going to be looking at the look back. Again, you set it at the beginning of the plan year. You take whatever their hourly rate is, beginning of the plan year, multiply it by 130 hours, take 9.5% of that, and you're allowed to charge that for all the months in the year that they're employed. There's no variation. Even if their hours are going to go up and down, that's your affordability standard for that employee for the entire plan year. So, to the extent that they're working fewer hours, and it's now a larger percentage of their pay, that doesn't matter. The safe harbor still stands. If they're not working for you anymore, you've offered them COBRA, so they're paying more than that anyway.
Yeah. I mean, kind of the same line of questioning, what happens with people that get holiday pays and bonus pays or profit sharing bonuses? How does that get factored in?
It doesn't. Again, it's the standard salary or the standard hourly rate as of the first day of the plan year. So you don't take into account bonuses, you don't take into account overtime, you don't take into account increases during the year. It's set at the beginning of the year as to whatever their pay is on the first day of the plan year. And you're using that as your method. So there's a certain attractiveness to that safe harbor because it is fixed, it doesn't vary, and you can figure it all out at the beginning of the plan year. But yeah, variations in pay, if they start working more overtime or they get a raise or they get a bonus, it's not going to affect that. It's going to be based on what their base salary was or what their base hourly wage was at the beginning of the plan year.
One question that comes, one of the things we keep hitting on, the fact is you're measuring this against not what your typical employee might buy. If they're a family family coverage and things like that, we're not measuring it against family coverage. We're measuring it against single coverage. One of the questions that come up is, we're going to have difference in terms of the calculations of premiums. Insurance companies are going to be allowed to take into account smoker versus non-smoker rates. So if I've got a smoker, maybe they're part of a wellness program. That's not his or her question here, but I'm going to throw this in because I know you've been working on this.
Yeah.
Wellness programs which give incentives, how does that factor into all this stuff?
As it currently stands, this is one of the things that may very well change. When you are determining affordability and you have wellness programs, you are allowed to presume that they have satisfied the standard with respect to being a non-tobacco user. You can, even if they're a smoker, you get to measure that 9.5% the affordability based on the premium charged to a non-smoker. There's a big push to discourage smoking, because as you may know, the wellness program penalty is now increasing in 2014 to 50% of the premium for a smoker penalty, or smoker reward, non-smoker reward, however you want to look at it. There's a big push and a big recognition that smoking cessation incentives are a good thing. So you are allowed to take into account any reward you would give for somebody who's not a smoker, or disregard any penalty you would apply on somebody for being a smoker. All other wellness incentives, if you're doing biometric screenings, if you're just doing, for example, health risk assessments, and it's an activity-only one, they just have to complete it, and they get a reward, or they get a decrease in the premium. The proposed regulations say you cannot take those into account. You have to presume, other than a smoker reward or penalty, you have to disregard all other rewards or apply all other penalties depending on if you start with the low one and add to it, or if you start with the high premium and back down from it. They've given us a transition rule for any wellness programs in place, I believe on May 5th of this year, that you get to carry those over to 2014 when you're doing your affordability analysis for 2014. You can still presume that somebody's going to satisfy all of the requirements, get the maximum rewards, avoid the maximum penalties, avoid all the penalties when you're doing your affordability analysis. But right now, that's only for 2014. As it stands right now, past 14, the smoker penalty or the non-smoker reward can be recognized when you're doing your affordability analysis. So that will be something else to keep. It seems to run counter to the whole push for the wellness programs, the fact that they're carving out tobacco use penalties or non-tobacco rewards. But right now they're saying the current rule is after 2014, affordability has to be measured presuming someone's not going to get any of those other rewards.
A couple questions about offering coverage here.
Okay.
We've got an employee who works an average of less than 30 hours a week, say for 6 months, and we change their position, and now they move or become full-time. How long do we have before we have to give them benefit coverage, or at least offer them benefit coverage?
They're basically treated the same as you would treat a new full-time hire at the time of their transition to the full-time position. So you would have the 90 days to offer them coverage. You don't get to continue them on in their stability period, in their measurement period, their initial measurement period, or any other measurement period. If they're a full-time employee, as of that change date, they're treated as a full-time employee, as if they were a new employee. They're not disadvantaged because they're transitioning while they're an employee, whereas a new employee would get the benefit of getting coverage within 90 days. They're treated the same as somebody you would hire in as a new employee, so it would be the same treatment.
And we keep mentioning the 90 days. I mean, that's the maximum. I mean, a lot of employers offer coverage far sooner than that. So you don't have to wait the 90 days. That's just the maximum period of time. So if your standard program has been, to have them have coverage first day of the month following hire or something like that, you can continue to do that. The 90 days is just a drop-dead date that you have to offer it, so you don't have to push it out. One of the questions that's come up frequently in programs that Tony and I have talked about is, well, our collective bargaining agreement says something absolutely, totally different, has different rules. Mm-hmm. We're all struggling with the collective bargaining rules because kind of in the 401k world, if you will, there are all kinds of special rules and things in terms of collective bargaining gets pushed off until the next negotiating period. unfortunately, right now, in terms of healthcare reform, we don't seem to have those same delays. A lot of these rules are going to kick in anyhow, it seems. It's kind of one of those things where we don't totally know the answer to. So it seems that they're going to kick in, and they're pretty much mandating what you're going to wind up having to bargain. This is going to set the floor for you.
Yeah, it's kind of unusual because in most other situations there's carve-outs for collectively bargained benefits. It's been universal. It's in, you know, in the qualified retirement plan world, there's always, you don't even have to test them for a lot of things, and we've always had delays, and they even did that in the grandfathering. When they came out with the grandfather rules, you got to delay things. There's been no indication at all of recognizing the special situations for collectively bargained employees with respect to these mandates. So it's a little puzzling. The only recognition that's we've really been given is that there's a transition rule for 14 that if you're contributing to a multi-employer plan, welfare plan for coverage for your collectively bargained employees, in some situations you're going to be deemed to satisfy the offering of coverage in the affordability rules. But that's the only recognition we've seen that, you know, collectively bargained employees have a whole different set of rules and a whole different set of situations that need to be addressed. And, you know, as it stands right now, it looks like there's going to be a lot of contracts being reopened to address this, to the extent that the contribution doesn't meet the affordability rule, or the fact that, you know, the threshold is higher than 30 hours a week as to who has to be offered coverage. It's really incumbent upon the employer to make sure that happens. There's really going to be no penalty for, you know, the union. Perhaps the employees, they're not going to have the ability to buy coverage through their employer, and they would, if they were, you know, should be getting between the 30 and 40 hours. Say your bargaining agreement only requires you to offer coverage to 40-hour-week employees. Somebody in that 30 to 40 threshold is going to have to go out and get coverage to satisfy the individual mandate, and they're not going to be able to get it through their employer. But the big exposure is on the employer, to whether or not they're offering affordable coverage or they're offering coverage to enough people, because they're the ones who can get penalized for it. But again, we both find it very odd that there's been no addressing of that particular aspect in any of this.
A couple more questions that make sense to ask now, just came up. One simply asked to re-explain that federal poverty line safe harbor. It's essentially, you look at the federal poverty line for the year.
For a single individual.
For a single person, federal poverty line for a single person. You take essentially a monthly piece of it, if you will. So 1/12 of the federal poverty line, so a monthly allocation of it, and your premium can't be more than 9.5% of that number. So whatever the federal poverty line for a single person is, 1/12 of that, think of it as a month, 9.5% of that. I use 2013 because we don't have 2014. That's when we'd be doing that. So that was that. Then just a question just on the rate of pay safe harbor. If an employee earns $10 per hour, what's the maximum employee requirement to pay for health insurance? So $10 an hour.
Well, I fortunately did that one.
Did you ask this question? Oh.
At $10 an hour times 130 hours times 9.5%, that's $123.50. So that would be the affordability threshold for single coverage for somebody who makes $10 an hour, who's a full-time employee for whom you're offering coverage. So,
okay. Can you get a contribution rate as a percentage of earnings up to a maximum of 9.5%? A percent rather than a dollar amount.
Percent of compensation?
Yeah.
I don't know why you couldn't. I mean, it's a design issue. It comes down to administrative complexity if you're going to start doing that for people based on what their wages are. You can certainly do that, but it means that your payroll system has to adjust each payroll period as to what, you know, if their hours are varying such that their wages are varying, and you've set the contribution as a percentage of their gross wages, you're going to have to program that in. It's certainly permissible. Again, it's something, presuming that the percentage is not going to decrease as compensation gets higher, you're going to be favoring highly compensated individuals over you're going to be favoring non-highly compensated individuals because their contribution rate will be, their dollar amount will be either will be lower or the percentage will be the same of their compensation. So from a non-discrimination standpoint, that's fine. it just becomes an administrative issue. But I'm not aware that there would be any
No,
prohibition on that at all.
I don't think so. Good. Two last questions, and we're going to move on here.
Yep.
Salesperson with commissions. Can we average for the year?
I don't know.
Yeah.
I'll be honest, I do not know.
Yeah.
That's probably, and it's very likely that's one of the situations they've asked for comments on, because the safe harbor didn't address, the proposed regs didn't address all of the possible ones. They've asked for comments on other situations. I'm thinking that's one of the ones they asked for comments on, but off the top of my head, that one I don't know.
And is the hourly employee rate of pay the best safe harbor to use for them? It's always tough to ask lawyers the best, because you know the answer is going to be it depends. It doesn't matter what the question is.
It's an administrative issue for you.
Yeah.
It's whether or not that can correlate with how you want to design your plan, to what extent affordability, and I guess that's a kind of a good transition into strategies about minimizing the penalty. Because there's two levels of penalty. There's two very different penalties. And the first one is definitely more onerous than the second.
Yeah.
The first requirement is that you have to offer minimum essential coverage, which is basically coverage that includes 10 categories of coverage as established by HHS. That includes some preventative coverage, it includes some pediatric coverage, it includes prescription drugs. You have to offer minimum essential coverage to substantially all of your full-time employees. That's the first requirement. Substantially all is a regulatory concept they've applied to this, which says you're offering to substantially all if you're offering to all of your full-time employees except the greater of 5 full-time employees or 5% of your full-time employees. That's the first requirement. Failing to satisfy that, meaning you have a full-time employee to whom you're not, if you have a full-time employee who goes out to the marketplace, to the exchange, buys an individual policy, and they qualify for a tax credit or a tax subsidy, any one of your full-time employees does that, you are subject to a penalty, and you are not offering minimum essential coverage to substantially all of your full-time employees. Any one of your full-time employees, even somebody to whom you're offering coverage, goes out to the exchange, gets a policy, gets a tax credit. You, as the employer, will be subject to a penalty of $2,000 per year for all of your full-time employees, including the ones to whom you offer coverage, including the ones who take your coverage. It's an omnibus and very onerous penalty. So that's, for the most part, the one you really want to try to work on avoiding. Now, that said, it's only triggered if one of your employees goes out to an exchange, gets a policy, and gets a tax credit. However, tax credits they're being a little generous with the tax credits, because they're giving credits to folks whose household income is up to 400% of the federal poverty level for their household size. And I believe for a household of 4 people, that's currently about $85,000. So there's a lot of people who could be eligible for credits or subsidies. Now, understand that if you have Medicare or any other kind of government or Medicaid, you're not eligible for a credit. But all it takes is one employee to go out and get a policy and get a credit. And if you can't prove you've offered coverage to substantially all of your full-time employees, you're going to get penalized for every one of your full-time employees, even the ones you offer coverage to, even the ones who take your coverage. That's the penalty you want to be careful of. That's the one you want to avoid. And there's a pretty basic strategy for avoiding that penalty, and that's offering minimum essential coverage to all your full-time employees. This doesn't go to minimum value, it doesn't go to affordability. It is just offering minimum essential coverage. And the tie-in here is that individuals have to get minimum essential coverage to avoid the individual penalty. That's what they have to do as individuals. So to encourage employers to offer that to employees, they've put in place this fairly onerous penalty. As long as you're offering a policy that offers minimum essential coverage, even if it's not even subsidized, and you're offering it to employees and their children, don't have to offer it to their spouses, but you do have to offer it to their children, you can avoid that first level penalty.
And the point is, kind of hammering on, it's not covering them.
No.
It's not covering them. It's offering the coverage. That's what you have to do. You have to offer. So that's going to tie into some of the things we're going to talk about is you just have to make it available. You could make it available and not subsidize any of it, which then helps as part of your strategy. So it's one of these things where I said you're not going to be able to not have a package of an insured product that will be available that will meet the minimum essential benefits, if you will, for the folks. How much you want to subsidize it as an employer is a different question, but it's going to be out there. So simply offering it can get you out of this most onerous piece of the penalty. Now we fall into the second penalty, which is different, but not quite as bad.
And you get to make some business decisions with the second piece, second penalty.
Mm-hmm.
The second penalty requires that you offer all of your full-time employees, not substantially all, but all of them, affordable minimum value coverage. We've talked about affordability. That means what you're offering to everybody, what they have to contribute for single-only coverage, doesn't exceed that 9.5% threshold for them. Minimum value coverage is different from minimum essential coverage, and it goes to how much of the benefits, how much of the cost of the benefits is going to be covered by the insurance, and it takes into account co-pays, deductibles, things like that. Based on our conversations with most insurance companies, it's going to be very, very easy to satisfy that 60% minimum value threshold with products. You're not going to have a very, very rich plan to do it. You're going to be able to get there. But that's what you have to offer to employees, all of your full-time employees, to avoid the second penalty. Second penalty gets triggered, and it's going to sound familiar. Somebody goes out, goes to the exchange, gets coverage, and gets a tax credit. However, in this case, you're only penalized on the employee that goes out and gets coverage and gets a tax credit, and only if you haven't offered them affordable minimum value coverage. So if you're offering them affordable minimum value coverage, even if they qualify for a tax credit, they go out to the exchange, you're not going to get a penalty, and it's only assessed on the individuals who actually go out, get coverage through an exchange, and get a tax credit. Those are the only possible employees on whom you can be assessed a penalty. So you can start making some strategic decisions. Affordability is that 9.5 threshold, but you can assess your employee workforce and say, are they going to be motivated to go out and go to the exchange and get a policy if I'm charging them 10% of their wages? If they don't go out to the exchange and don't buy a policy there, you can't get a penalty for them. It's not going to happen under the second penalty. So to the extent you make it easy for them to enroll, and it's close to the 9.5, if it's over and they enroll in your coverage, you're not going to get a penalty for them. So part of it is knowing your workforce. Part of it is knowing, are they going to really, if you're charging them 10%, are they really going to go out? Now I understand they've pulled back on the application for the individual coverage. It's not 15, 20 pages. It's been shortened a little bit. But are they going to go out and actually do that, or are they going to take the convenience of getting it through the employer? It's one of your strategic decisions to make. The other thing to remember is that not every option you offer them has to meet the affordability standard. Only one option has to meet that standard. If you have different tiers that you offer your employees, only the lowest cost tier has to meet that affordability and minimum value threshold. You can offer other options, better coverage, higher contribution, that's fine. As long as everybody has all of your full-time employees have the opportunity to buy minimum value coverage at the affordability level, you're not going to be exposed to a penalty for them.
And so a lot of times in terms of planning, you've got the program that you're used to with all the levels and all the variations and things like that. And if you look at that schedule today and say, none of these are going to make the 9.5%, they're all more expensive than that. Well, one of the strategies that Tony's alluding to is that, well, you find that piece that does, and you slide that into your program. So you offer the 15 variations you have now you offer 16. The 16th is this minimum coverage that's, satisfies, this is what they call the bronze level coverage, if you will. You know, I was joking back when the Olympics were on, you know, it was bronze, silver, gold, platinum type program. This is the bottom level. This is the 60%. There will be, and I'm not an insurance guy, but I know there's a lot of insurance guys out there. The marketplace is going to have this. The insurance companies will develop this product if they haven't already. It's going to slide in there. You just add that to your menu. You don't have to change anything else. If nobody takes it, you're still satisfied. You're okay. You know, we think it's all going to work. That is a way that's been pitched out there. Someone had raised a question about what they call skinny coverage out there that has only, you know, doctor's appointments and things like that, doesn't cover hospitalization. Is that pretty much gone? Is that loophole gone? I think the answer is yes.
That's probably not going to satisfy minimum essential coverage. It's not going to cover the essential coverage requirements that HHS requires. So you're going to have to be above that level to even avoid the first level penalty. But you know, again, there are high deductible plans that are going to satisfy minimum essential coverage to get you past the first penalty, and there are going to be structures that are also going to satisfy the second level for the minimum value, and it's just a matter of pricing the option appropriately.
Okay. Question about the tax treatment of this penalty. Deductible?
Nope. Of course not. That'd be way too easy.
It's technically an excise tax.
It's an excise tax. It's designed to discourage you from not offering coverage. So the penalty is, you know, it's payable. So, you know, there are employers who are going through the analysis of, well, I'm just not going to offer anything. You know, that's it. I'm going to pay my employees more. Let them go out and get their own coverage, and I will pay the $2,000 per year penalty. And that's certainly something you can do as a business decision. But again, it's not a deductible penalty. And to the extent that you're currently offering health insurance with any kind of a subsidy, you've obviously already made a business decision that this makes sense for your workforce. There's recruiting and retention, or there's other reasons you're offering it. Have those really changed? I mean, are you going to put yourself at a competitive disadvantage if you don't offer coverage to your employees? I mean, it's not as simple as walking away from it for a lot of employers, especially if you're already offering coverage. Like I said, you've already made that business decision. This is a modification to that. You know, do you want to take the risk that somebody's going to go out and get coverage and expose you to the penalty because you're not offering it to 95% of your full-time employees? It just seems to me to make no sense to expose yourself to that penalty when all you have to do is offer coverage. You don't have to subsidize it. You just have to make it available to get past that first penalty.
Right. I mean, there was a lot of emotion when this first came out, and a lot of employers said, I'm just not going to do it. I think as a practical matter, people aren't going to walk away from it. At least you know, medium and smaller size and larger companies are going to do it. Maybe the really small situations might, but you're going to do it. We got a lot of questions about minimum value versus affordability. We're still kind of working our way through this. Affordability, I'm going to let Tony answer minimum value. The affordability is this 9.5% that we keep talking about. You're measuring that. How much are you charging the employee for this coverage? That's what affordability is measured by. Minimum value
is an actuarial determination. All right, most people, I know I can't, by looking at what a policy offers versus what you're paying for it and decide if it's offering minimum value. That's something that an insurance professional is going to have to help you with. As I mentioned, the ones we've talked to have said most products are satisfying that. It's fairly easy to find products that satisfy that, insurance products or self-insured plan designs that satisfy that standard. How exactly you determine it, I couldn't tell you, because it goes to what the co-pays and the deductibles are as opposed to expected expenses, and like I said, it's an actuarial calculation, but it's something that any particular policy, an insurance broker, agent should be able to tell you if it satisfies that coverage. But it is completely separate from what you are charging your employees for that coverage.
And one of the questions that was raised here is, well, we got a program that, it's covering the employee and the dependent. If you looked at it, it's affordable to the employee but not to dependent. That's not what you're looking at. You're not looking at what the employee actually buys, if you will, or purchases with you. You're measuring this against single person coverage.
Right. Single person coverage.
The fact that the employee needs to go out and cover spouses and cover dependents and does all of that, and that's more than 9.5%, that's okay. That's okay. That's fine. You look at single person coverage. That's what you're measuring against. Not what they, if none of your people take single person coverage, that's okay. But as long as that is not more than 9.5%, you're fine.
Right, there's no obligation to subsidize coverage for dependents. And it's also, as we said, you don't have to cover spouses. There's a reason for that, believe it or not. It's actually kind of a thought out process, because when you offer coverage, it still doesn't make sense to me, so that's why I'm kind of struggling with it. If you offer children's coverage to your employees, but it's not subsidized, it could be 100% of the cost over and above single coverage. That child is now prevented from going to the exchange and getting a tax credit for coverage because they've been offered affordable coverage through the parent's employer. They carved spouses out, figuring that spouses might be more inclined to want to go out and get coverage through the exchange and qualify for a tax credit. If you offer spousal coverage, even if it's not subsidized, and the employee-only piece is affordable, the spouse now cannot get a tax credit by going out to the exchange because the employee's coverage was affordable. As I said, it doesn't make a whole lot of sense to me, but that is why they ended up carving spouses out, so that you don't have to cover spouses if you don't want to, and spouses can still go out and get a tax credit if they get coverage through the exchange. And we've had the questions like, well, we've always covered spouses, how do we tactfully back away from that? And there probably isn't a tactful way to do it. But it's understanding that if you keep it in there, you've basically penalized every employee's spouse if you are providing affordable coverage or offering affordable coverage. So there's that, there's that tension there. Again, it's kind of, part of it is knowing your workforce. If nobody's covering their spouses, but a lot of people are covering their kids, it's not going to be that big a deal. And if the spouses are working and they have their own coverage, they'd have to get affordable coverage through their own workplace. But there's very few workplaces that are going to be that clearly delineated. The question is, if you're going to do the absolute minimum and offer, but you still want to leave spouses on there and you're not going to subsidize that coverage, you're pretty much penalizing your employee spouses to the extent that they could have gone out to get a credit and they can't because you have offered them coverage even though it's not subsidized at all.
We've got a couple more questions about the calculation of the penalty, if you will. We got one person goes out to the exchange and gets a credit. Is it on all the people in the company, and what about control groups, and how does that fit together?
First level penalty. If you don't offer minimum essential coverage to substantially all of your full-time employees, that would be determined on the entity basis in the control group. It's not done on a control group basis. It's done based on the entity within the control group. You also get, remember, it's also important to keep in mind, you get a free pass on your first 30 violations, so to speak. Your first 30 full-time employees, you don't get a penalty on. So if you have 29 full-time employees and you don't offer them all minimum essential coverage, you technically have a penalty, but you get to subtract your first 30, so you wouldn't really have a penalty. But the first level is on all of your full-time employees after the first 30. The second penalty is only on the employee that goes out to the exchange, gets a credit, and you didn't offer them affordable minimum value coverage. Again, you get a free pass on the first 30. That is also determined on an entity level basis. That free pass, however, the 30, is on a control group basis. And you have to allocate that amongst the members of the control group based on the number of employees. You don't get to pick and choose how you allocate it. It's pro rata based on how many employees this entity has and how many employees that entity has of the total. So if one entity has 10% of the employees, they would get 3 free passes. If another entity has 50% of the employees in the control group, they would get 15 of them. You don't get to pick and choose how you allocate those 30, but they are allocated among the controlled group. But the penalties are determined on an entity-by-entity basis. They're not done on a control group basis. So you could have one entity in the control group that complies with everything, and they wouldn't get any, and if another member of the control group doesn't offer coverage to everybody, this entity over here that's in compliance won't be penalized for what this entity over here is doing. So you do have some insulation, but again, that 30 free passes, so to speak, does get allocated, and you don't have any control over that. It's based on the number of full-time employees.
A couple things we wanted to talk about too in terms of hidden pitfalls and all this as we're coming to the end. One of the things we've alluded to a lot, kind of tangentially, if you will, through all of this, is there are new rules in terms of non-discrimination in terms of health plans. For years and years and years, there have been non-discrimination rules covering self-funded health plans. They have not changed. They're still there. They continue to operate on who you have to offer coverage to. One of the things that has changed, and it's going to make a dramatic difference, and it is technically in effect right now, is that insured health plans now have to follow non-discrimination rules. Until healthcare reform, there were no non-discrimination rules in terms of insured products. You could do all kinds of different things. You couldn't violate normal labor laws. You couldn't offer it to men and not to women and those kinds of things. But you could offer it to different classes of employees. You could charge different amounts. You could cover certain people and not cover other people. What tended to control it was more the insurance underwriting rules than the law. The insurance underwriting rule says you got to contribute. We expect to have so much of a premium from the employer. We expect you to cover X% of your workforce. That was not the law. I know the insurance companies told you it was, but it was not the law that you had to cover these folks. With healthcare reform, there will be discrimination rules dealing with insured plans. They are in effect right now, but we don't know what they are, okay? Technically, they are effective. Not 2014, it was 2 years ago, I think. The only reason we're not doing anything about it is that the agencies charged with it said, don't do anything until we tell you what to do.
Well, they basically said, we're not going to hold you responsible for what we haven't told you what you have to do yet.
Yeah.
So there you go. And they will only be effective prospectively. They've already said that they will give you time to implement and design for them. At this point, I would imagine they're not going to be out for 14. They're not going to be in effect for 14 because they're not going to, at this point, unless something comes out in the next, no, we're not even going to, well, no, we'd have 6 months till the end of June, I guess. Because usually the lead time is usually about 6 months. I haven't heard that they're even in the pike, that they would be coming out in June. So at this point, probably not for 14.
And that's some of the things we talked about is, okay, we're designing this and trying to make affordability and doing different things, is once those rules roll out, all of this is going to get rolled up together, and we're going to have to figure out. And unlike the non-discrimination rules for self-funded plans, the non-discrimination penalties for insured plans are far more onerous, much more expensive, and you're going to want to comply with them rather than get into all those details. So that's one of the hidden pitfalls that we don't have any idea what the rules are. We can surmise and guess. I would imagine if you're offering the same coverage to everybody and the same prices to everybody, you're going to be fine. But if you want to bracket things and do things differently, we may need to be revising those thoughts.
And again, a key point here is that these non-discrimination rules won't be applying to grandfathered plans. If anybody still has a grandfathered plan, that's probably the only reason you're holding on to it, because it's an executive-only plan and you just want to be able to continue to offer that plan only to your executives. But again, so, you know, there's a small group of plans that are still carved out of those non-discrimination rules, and we really can't, unfortunately we can't say what the disadvantages of dropping grandfathered status, because we don't know what those rules are going to be yet. These are from online. We probably want to get to those.
Sure, please do.
But you can take the first one because I can't do the first one.
Can
I
you,
have no idea.
Can you tell me if there's a special requirement that a federal contractor is recommended to hire an actuary to determine if their plan meets the minimum value standards for a large group? I have a client who intends to offer benefits to their Davis-Bacon employees and meet the 9.5% affordability threshold. Are there calculators for plan values insufficient? I'm not aware of any particular federal rule for contractors that's different than federal rule on health benefits for everybody else. I know there's lots of special rules for federal contractors, but I would think they would just use the same calculation that anybody would use in the non-federal contracting arena. but I'm not aware of anything. So we're going to have those calculations being made. Question, we employ several people who are 65 or older, and both on a full and part-time basis. If they're eligible for Medicare, do we have to offer them coverage through our group plan? Well, this is lots of calculations in this one. And if so, what if they already have a Medicare supplement?
Well, if you have more than 20 employees
20.
and you're subject to the Medicare secondary payer rules, and you have to offer them coverage,
Right.
Unless they voluntarily opt out. They can voluntarily opt out. You cannot incentivize them to opt out, and Medicare has to be secondary for the working aged. So if you're over 20, you're supposed to be offering them coverage anyway. That has nothing to do with the Affordable Care Act.
Right.
The benefit of that is that if they go out to the exchange and want to buy a policy for whatever reason, they're not going to be eligible for a credit. So they can't trigger a penalty for you just by going out and doing that. But they're still counted for all purposes if they're full-time employees, whether if they have Medicare coverage or Medicaid coverage or anything like that, they still get counted. There's no carve-out for them. And you would still have to offer them coverage the same as any other full-time employee.
If you're offering to all and they still get a policy or credit under the exchange, are you penalized?
If you are just offering minimum essential coverage to substantially all of your full-time employees and somebody goes out, yes, you can still get penalized. If you're offering minimum value coverage that's affordable, no, you will not. That's the difference between those two. If you're offering coverage to everybody, if you are offering coverage to substantially all, they can still trigger a penalty. No, I'm sorry, they can't. I'm sorry. They can't trigger a penalty there. But they can still trigger a penalty on the second one if they go out and get a credit, if you're not offering affordable coverage. So they could still technically trigger a penalty. It just depends which penalty it is.
It seems like some people are still kind of struggling about this affordability, which one you measure. The question is, you've got multiple options, different benefit structures under your plans. Which do you measure the affordability against? The affordability against is single person coverage.
And it's only one option has to meet that standard.
Right.
Doesn't have to be all of them.
Right. So right now, if you've got a single person coverage that's costing 10%, our suggestion is find something that you can charge or subsidize it more, so it's 9.5%. That's what you measure. The fact that you can get, gold-plated program that's going to cost you 20%, that's not the one you're measuring against. It's single person, that's what you're measuring. So if you don't have it now, I would talk to your broker and find one, very seriously. Does COBRA go away?
No. It's going to be probably less popular than it was, but there's nothing. Now, certificates of creditable coverage go away. Pre-existing conditions go away, which is another question that I had. Will employers still shop for insurance? Will employee pre-existing conditions application be eliminated? Yes. Effective 2014, all pre-existing condition exclusions have to be eliminated. They're currently eliminated for children under the age of 19. They're eliminated for everybody beginning in 2014, which is why you also don't have to do certificates of creditable coverage. They're actually taking one thing away. You don't have to do certificates after 2013 because they won't be necessary. There will be no pre-X's that you have to, waive with proof of prior coverage. Employers still shopping for insurance? Sure. The Department of Labor has been very clear that it's not going to be permissible to just give your employees money and let them go out and get an individual policy and satisfy your requirements under these penalties. It's not going to be considered a group health plan. You're not going to be able to do that. But employers are still going to want to, depending on the experience of their group, get the best deal. Again, cost is going to be a concern because you're going to want to keep it if you're trying to meet that affordability standard. So you are still going to be shopping. The shop exchanges, which are the employers in the 0 to 100 to 100 employee category, the ability of them to go out to the exchanges and put together a menu for their employees to choose from. Those have been slightly delayed, but that's one of the mechanisms where an employer can go out and say, fine, I'm going to offer my employees these options, I will subsidize it through the exchange, but they're really getting their policies through the exchange facilitated by their employer.
One of the things we've mentioned a lot, and you've heard a bit about, is these exchanges that we're talking about.
Marketplace. It's a marketplace.
It's a marketplace now.
It's not an exchange, it's a marketplace.
It's a marketplace. The concept is this is going to be this electronic, well, I assume electronic for the most part, place where an individual can go and see a menu of different options that they can purchase and buy. The only one that's out there right now, California rolled its out a week and a half ago, something like that, and they got 13 different options. Ohio has opted not to create its own exchange and is going to wait for the federal government to do it. I'm thinking of our other markets. I think Michigan is...
I thought we were partnering, but I'm not
maybe,
sure where they're at right now with it, frankly.
Illinois, I think, is also opting for the federal, but these are supposed to be in place by October 1. So far, out of 50, we've got 1, so there's 49 to go. Now, that's not your problem, if you will, as employers, or because that's somebody's problem, but it's not ours.
It's more for individuals who have to be covered and need to go out and buy an insurance policy. It's going to make it more difficult for them to find an individual policy. So any delay in the exchanges is going to be more of a problem for individuals satisfying the individual mandate to have coverage.
Well, the question along those same lines is the employer is already offering a bronze level plan. That's at 60% level. That's the minimum that they have to. And it meets affordability. And you've got an employee who says, I don't want that, goes off to the exchange, to the marketplace, excuse me, and buys a platinum plan. Are they going to get a credit?
If you're offering a minimum value plan that's affordable, first off, they probably won't be eligible for a credit because they are being offered affordable coverage for their employer. But even if they were, based on their household income or however that's going to work out, you're not going to be subject to a penalty because you're offering them affordable minimum value coverage. Again, presuming you are meeting the first threshold, which is that you are offering it to substantially all of your full-time employees. And if they're being offered minimum value coverage that's affordable, you're not going to be subject to a penalty, regardless of what they do. So that's how you insulate yourself from that penalty as well.
Question, we were talking about the non-discrimination rules. Question was raised, currently a self-funded plan. I already have to comply with the 105H discrimination rules. You've had to for years and years and years. Are those changing? To my knowledge, right now, those are not changing. Those rules are still in effect. They have not changed. This does not impact any of those. That stays the same. Only insured plans, which didn't have to follow any of these rules, are now going to have to follow them. Kind of a follow-up, they said, well, I've got a self-funded plan, but I've got an insured portion. I'm assuming by the insured portion, they're referring to the stop-loss policies that most insured plans have. That's the fact that you have a stop-loss policy on a self-insured plan has not turned it into an insured plan. So
presuming the stop-loss is written to the benefit of the employer,
true,
and not to the plan.
True.
Which is because if the stop loss is insuring the employer against losses, you have not insured the plan. You have protected the employer from their losses associated with funding the benefits. If the stop loss insurance is written to the plan, you have a different animal altogether, and you could have just turned your plan into a partially insured plan. So most stop loss insurance is written to the employer. It's very rare that it ends up being written to the plan, but that is a distinction that's been drawn in that particular area.
One of the questions that's come up, and I'm going to turn this to Tony, is HRAs. Became, I don't know how popular, but HRAs have been around for a little bit. The idea is that's kind of a mini self-funded plan that employers offer. This is money that's pure employer side. Employees don't have to put anything into it. It's not the flexible spending account that you'd have through your cafeteria plan. This is, employer says, you got $1,000 that you can use for health benefits. It's out of my pocket, you can use it. Is that going to still be around? Can we still use those?
Well, there's the problem. The potential problem is that all HRAs, health reimbursement accounts, are group health plans, and as a group health plan, unless they are accepted from all of the healthcare reform rules, they have to comply. And the big one here is not so much what's covered, because most of them are any permissible medical expense. The problem is the annual and lifetime limits. Clearly, because you're usually saying you've got $2,000, $5,000, whatever, you're putting a limit on that every year. So you're clearly going to run afoul of the limits. There's the agencies have drawn a distinction, because in recent years a number of employers have wrapped HRAs around high deductible health plans and kind of said, fine, we're going to self-fund your deductibles, your co-pays, bring it back down to the level you had, but we can buy a cheaper insurance product, and the total dollars are less. an integrated HRA is going to be fine. If it's an integrated means if somebody elects the other primary major medical coverage, the regular coverage, and this HRA is integrated with that such that it comes part and parcel with it, that's going to be fine. You're not going to have any issues with that. You're going to be allowed to keep that. Annual limit is not going to be a problem for you. There's some disagreement as to how the rules are applying to non-integrated HRAs. There is a provision in the regulations that says that an HRA that qualifies as a flexible spending account under Code Section 106 is not subject to the annual or lifetime limits. On a first reading, that would imply, it seems to indicate most regular HRAs because you are reimbursing certain expenses and the amount that you can get is not more than 5 times what the annual benefit is. So if you don't have rollovers that accumulate too much, you could probably qualify for that. The confusing part is that the Department of Labor has issued some question and answers that indicate that non-integrated HRAs are just not going to be permitted after 2014. So we're still trying to work through how those are, if there's a reason the Department of Labor has said that when the regulation says what appears to be something very different. But to the extent you have an integrated one, we know those are fine. So to the extent you're still providing, you're buying a cheaper insured product and wrapping an HRA around it because the total dollars are cheaper for you, you're going to be able to continue to do that. It's the non-integrated ones, there seems to be a little bit of confusion as to whether or not they're going to be permissible going forward. We're actually looking at that and we're just as confused as everybody else. But hopefully there'll be some more guidance in that area so we can have some more clear guidances because HRAs are a nice thing to have, nice thing to offer as an addition to a group health plan as a non-integrated benefit. But as I said, it's not clear right now if they're going to be able to go on because of the annual and lifetime limit issue.
Well, I've got noon or just a little after, and for those of you on the webcast, we promise to conclude at noon Eastern time for you. You can continue to email your questions, and we will get back to you. For those of you here in Cleveland, you're invited to stay for lunch, and we will be happy to continue our discussion with you and the answer question, any additional questions and answers, and a little bit more free-flowing situation. For all of you, our healthcare reform team continues to track news and developments regarding healthcare reform requirements. As you can see, there's lots of moving parts and lots of unanswered questions, so we're still trying to do that. One of the ways that we communicate that to you is on our new online community called the Business Advocate. We encourage you to join the discussion within the Business Advocate community at businessaDvocate.mcdonaldhopkins.com. The URL is on the front page of your handout. And with that, that concludes our webcast, and I thank you all for joining us. And please, here in Cleveland, stay for lunch. Thank you.